Defining your investment goals. Warren Buffett likes to say that the first rule of investing is don't lose money. And the second rule is never forget the first rule. I too believe that avoiding loss should be the primary goal of every investor. This does not mean that investors should never incur the risk of any loss at all. Rather, don't lose money means that over several years an investment portfolio should not be exposed to appreciable loss of principal. While no one wishes to incur losses, you couldn't prove it from an examination of the behavior of most investors and speculators. The speculative urge that lies within most of us is strong. The prospect of a free lunch can be compelling, especially when others have already seemingly partaken. It can be hard to concentrate on potential losses while others are greedily reaching for gains and your broker is on the phone offering shares in the latest hot initial public offering. Yet the avoidance of loss is the surest way to ensure a profitable outcome. A loss avoidance strategy is at odds with recent conventional market wisdom. Today, many people believe that risk comes not from owning stocks, but from not owning them. Stocks as a group, this line of thinking goes, will outperform bonds or cash equivalents over time, just as they have in the past. Indexing is one manifestation of this view. The tendency of most institutional investors to be fully invested at all times is another. There is an element of truth to this notion. Stocks do figure to outperform bonds and cash over the years. Being junior in a company's capital structure and lacking contractual cash flows and maturity dates, equities are inherently riskier than debt instruments. In a corporate liquidation, for example, the equity only receives the residual after all liabilities are satisfied. To persuade investors to venture into equities rather than safe debt instruments, they must be enticed by the prospect of higher returns. However, the actual risk of a particular investment cannot be determined from historical data. It depends on the price paid. If enough investors believe the argument that equities will offer the best long-term returns, they may pour money into stocks, bidding prices up to levels at which they no longer offer the superior returns. The risk of loss stemming from equities placed in the capital structure is exacerbated by paying a higher price. Another common belief is that risk avoidance is incompatible with investment success. This view holds that high return is attainable only by incurring high risk, and that long-term investment success is attainable only by seeking out and bearing, rather than avoiding, risk. Why do I believe conversely that risk avoidance is the single most important element of an investment program? If you had $1,000, would you be willing to wager it, double or nothing, on a fair coin toss? Probably not. Would you risk your entire net worth on such a gamble? Of course not. Would you risk the loss of, say, 30% of your net worth for an equivalent gain? Not many people would, because the loss of a substantial amount of money could impair their standard of living, while a comparable gain might not improve it commensurately. If you are one of the vast majority of investors who are risk-averse, then loss avoidance must be the cornerstone of your investment philosophy. As the table illustrates, Perseverance at even relatively modest rates of return is of the utmost importance in compounding your net worth. A corollary to the importance of compounding is that it is very difficult to recover from even one large loss, which could literally destroy all at once the beneficial effects of many years of investment success. In other words, an investor is more likely to do well by achieving consistently good returns with limited downside risk than by achieving volatile and sometimes even spectacular gains, but with considerable risk of principal. An investor who earns 16% annual returns over a decade, for example, will perhaps surprisingly end up with more money than an investor who earns 20% a year for 9 years and then loses 15% the 10th year. There is an understandable, albeit uneconomic, appeal to the latter pattern of returns, however. The second investor will outperform the former 9 years out of 10, gaining considerable psychic income from this apparently superior performance. If both investors are money management professionals, the latter may also have a happier clientele 90% of the time they will be doing better, and thus a more successful company. This may help to explain why risk avoidance is not the primary focus of most institutional investors. One of the recurrent themes of this course is that the future is unpredictable. No one knows whether the company will shrink or grow, or how fast, what the rate of inflation will be, and whether interest rates and share prices will rise or fall. Investors intent on avoiding loss, consequently, must position themselves to survive and even prosper under any circumstances. Bad luck can befall you. Mistakes happen. The river may overflow its banks only once or twice in a century, but you still buy flood insurance on your house each year. Similarly, we may only have 1 or 2 economic depressions or financial panics in a century, and hyperinflation may never ruin the US economy. But the prudent, far-sighted investor manages his or her portfolio with the knowledge that financial catastrophes can and do occur. Investors must be willing to forego some near-term return, if necessary, as an insurance premium against unexpected and unpredictable adversary.